Look, Kevin Warsh I've known for a dozen years. He's accomplished, he's respected. He has a paper trail, and he's been quite specific in his assessment and in many cases criticism of Fed practice, really along three dimensions. The balance sheet he thinks is too big. The Fed has gotten into credit allocation and mortgages. He's been critical of forward guidance, information the Fed provides about future rates. And he's been critical that the Fed has not really anchored its policy in policy rules. And so over time, not on day one, but over time, Jonathan, we could see the Fed adjusting policy along all three of those dimensions, including the balance sheet.
Well, let's start with communication and then turn to the balance sheet. The post-GFC Federal Reserve and the communication apparatus, I'm sure there were certain things that you were frustrated with yourself when you were at the Federal Reserve. What would you like to see change, and what do you think ultimately Kevin Warsh will change?
I think there are a couple of things I would highlight. First of all, it's very possible to run a successful monetary policy without any forward guidance. Paul Volcker did it for 8 years, and Alan Greenspan did it for his first 17 years. Forward guidance providing information about future rates really became into focus at the Fed in the global financial crisis. Rates were at zero, and the markets kept pricing in rate hikes. And so the Bernanke Fed said, we're not hiking rates. And so I think it is legitimate for the Fed to have a conversation and discussion about the costs as well as benefits of forward guidance. It could be about the dots. I think it's more than just the dots. So I think that's probably a direction they'll move, but it's not going to change overnight.
So I'm just thinking, is this basically going to spike the dots? And you're saying, well, you know, that's a big part of it. I mean, do you expect there to be some sort of limit on how much other Fed members can speak, right? So there's this question of how much the Fed has been dominated by the person at the top. Yeah. It has always been the Bernanke Fed, or what we got with respect to Fed Chair Powell and the Powell Fed. Yeah. Is this going to be the Warsh Fed, or is there going to be a different dynamic given some of the dissents that we're likely to get?
I think it will be the Warsh Fed. I think it's helpful that Kevin knows the institution. I think that will be important in terms of shaping it in his direction, but it will take time. As you point out, it's a good question. The chair has the power of persuasion, but at the end of the day, he or she only has one vote. Congress set up the Fed to require that interest rate decisions, hike or lower rates, require an affirmative vote of a committee, and the committee has 12 members. Now, in the time we've all been following the Fed, the chair almost always gets his or her way. But if you go further back, we've had situations where the chair has been outvoted on both discount rate and federal funds rate changes. I'm not predicting that, but what I am saying is Kevin Warsh will have to work with the committee and will have to bring the committee along with him if he wants to make the changes that he says he wants to make.
Does the committee include Treasury Secretary Scott Bessent? And I ask this because we're talking about a potential accord between the Federal Reserve and the Treasury. We also have heard Treasury Secretary Bessent talking about Fed policy, what he expects them to do with the balance sheet, which raises this issue of whether, as Krishna Guha says, he has a soft veto over what Kevin Warsh would do. I mean, what's your sense of what this looks like?
Well, it's a complex issue, but let me distill it. The Fed balance sheet and profitability is ultimately consolidated with the Treasury. And so ultimately, the stock of Treasuries outstanding is going to reflect the issuance that Scott Bessent oversees and the Fed's programs of quantitative easing. And I think it is appropriate to have a discussion with the Fed and the Treasury over time about the way to balance off the objectives of the securities outstanding. Without, of course, impinging on the Fed's ability to set monetary policy. It's possible to do that. The Fed could run monetary policy with a much shorter duration portfolio, as was the case before the global financial crisis. And also, remember, if you go back to the early days after the global financial crisis, the Fed was actually talking about selling securities and very quickly getting back to a small balance sheet. And so these are complex issues. It's not going to change overnight, but I think they are legitimate areas to have a conversation.
They're not going to change overnight, and the Treasury Secretary made that clear in his interview over the weekend. He said, I wouldn't expect them to do anything quickly on the balance sheet. So what kind of timeline are we actually looking at?
Well, given that the Fed's been talking about this off and on for 15 years, it may be a very long timeline. And in particular, the Fed has made the decision, which could be changed, that it does not want to sell any securities. And so when the Fed is shrinking its balance sheet through so-called QT, it's not selling anything. It's just letting existing securities roll off. Other central banks do sell assets. The Bank of England regularly sells gilts into the gilt market. The Fed itself has talked about selling mortgage-backed securities. And so these are all ideas that have sort of been in the conversation at the Fed for a while, but it's not going to happen overnight.
The Trump administration says they want to take politics out of the Fed. We just heard from Bob Elliott. He was saying how Kevin Warsh isn't hawkish or dovish. He's a political animal. I don't know if you saw over the weekend, but there was a chart really going all over Twitter where you could see his rhetoric changing depending on if it was a Democrat or Republican in the White House, especially depending on if he was maybe in the running to be Fed chair, how dovish he became. What do you make of that, given how long you've known him?
I didn't see that chart. What I would say is the Fed under Jay Powell in the last year and a half has been cutting rates, and the dots, those infamous dots in December, showed that a majority of the committee thought at least one rate cut this year would be appropriate. And so I don't necessarily infer anything other than Warsh sees the economy as the Fed did, at least in December. I do seem to remember Kevin not being entirely complimentary of the Powell-Clarida Fed either during my time there. So I don't think it's entirely driven by any of those considerations.
Rich, can we finish on Torsten Slok of Apollo? He put out this over the weekend. A lovely reaction to it. He said the U.S. economy is about to take off. Later this year, the conversation in markets will change from talking about Fed cuts to instead talking about the Fed having to hike. What's your reaction to hearing that?
I think I've said on this show, I think there is an upside case for the economy this year. The tech CapEx boom is real. There will be those big, beautiful bill tax cuts that people are getting. Foreign companies are building plant and equipment in the U.S. Whether or not Powell was asked that question perhaps by Mike McGee at the press conference recently about rate hikes, and he more or less said that's not something that we're thinking about right now. But it gets to the forward guidance issue that we discussed a moment ago. It may well become part of the conversation if we get an economic boom this year, especially if inflation doesn't return back towards the target. And at that point, the forward guidance, the skepticism about forward guidance that some have indicated, including Kevin Warsh, may come to a test.
Rich, it's good to see you. Always great to catch up. Thank you, sir. Richard Clarida there, the former Fed Vice Chair and now back, of course, over at PIMCO.